or basically EPS, and we were able to discuss a number of issues as far as this topic is concerned. First of all, we started by defining what is earnings per share, and basically we said this is the amount of profit or basically the amount of earnings which is attributable to each equity or ordinary share which has been issued by the company. That amount of profit which is attributable to one ordinary share, basically refer to that as what? As EPS. Now, what we said is that all the listed companies, and actually we say listed companies are those companies whose shares are trading in the securities exchange market. They're required by the International Accounting Standard number 33, basically to compute and also disclose two types of earnings per share: the basic earnings per share and the diluted earnings per share. So therefore, these are the two types of earnings per share. These are the two types of earnings per share which the listed companies are required to compute and disclose: basic earnings per share and the diluted earnings per share. And we also talked about the use of this particular earnings per share, or how this earnings per share is used by various users. Number one, we said it can be used in terms of evaluating the profitability of the company. Number two, we said it can be used in terms of comparing the performance of the company in different years. Earnings per share, we said, can also be used to compare performance of different entities within the same industry. And finally, we say that this earnings per share can also be used by as a basis of computing something called the price earning ratio. We talked about those particular uses or those importances of this earnings per share. Then from there, we started by looking on how we compute this one. That is the first type of earnings per share, and that is the basic earnings per share. The basic earnings per share, and actually this one we said is abbreviated as BEPS. BEPS. So BEPS, or the basic earnings per share, we said is an earnings per share which is computed by the listed companies using the profit for the current year and also using the number of ordinary shares issued and fully paid at the end of the year. So how do we compute this basic earnings per share? Basic earnings per share, we said, is computed by taking the PATOS. We divide that with something called the one-offs. We divide that with something called the one-offs. So basically, we said PATOS. This is a short form for profit, which is also known as earnings, which is basically attributable to the ordinary shareholders. So the profit attributable to ordinary shareholders, and basically we divide that with the one-offs. One-offs is a short form for weighted average number of ordinary shares. Weighted average number of ordinary shares. So basically that's how we compute the basic earnings per share. So in our case, we started by looking on how we compute the first item within our equation here, within our formula, not equation, within our formula. So we started by looking on how we compute the PATOS, which is the profit attributable to ordinary shareholders. And actually we say this computed by taking the profit after tax, PAT, or the net income, or the profit for the year. The profit for the year. The examiner, we said, can use any of those words, but basically all these means one and the same thing. So we take that, and basically to this we said we left two items. We left the preference dividends. The preference dividends for the current year only. For current year only. For current year only. only. And remember, there is something I mentioned in addition to this. We say that you may come across some questions whereby you are told the preference shares issued by the company are basically what? Are redeemable. So we said, in case you come across such a question, you're told the preference shares issued are redeemable. We said we don't list their dividends here, simply because redeemable preference shares, number one, is part of the non-current liabilities. Number two, their dividends are classified as part of the finance cost. Remember, in arriving at this profit, we all expenses, including the finance cost, have already been deducted. So therefore, if the preference shares issued by the company are redeemable, don't less their dividends here, because they have already been deducted in arriving at that profit as part of the finance cost. So to this, we also said that we less the profit attributable to the non-controlling interest. So basically, this is a price whereby we are computing the earnings per share for a group of companies. And then to this, then we said we add any loss from the discontinued operations. Any loss from the discontinued operations basically should be added there. And whatever you get here, we refer to that as what? We refer to that as PATOS. Remember, that's something we were able to discuss in length in our previous class. We were able to discuss in length in our previous class on how we compute what? How we compute the PATOS. Equally, give more explanation on what we mean by discontinued operations and so on. So in today's session, I want us to look on how we compute this, and then also we do a question from a past paper. So weighted average number of ordinary shares, that is the one-off. So how do we compute this one? How do we compute the weighted average number of ordinary shares? So this one is computed basically by taking the number of ordinary shares which had been issued and free paid at the start of the year. In other terms, we refer to those shares as the ordinary shares which were outstanding at the start. These are shares issued and free paid at the start, and then we add the other shares which were issued by the company during the current year. So this is computed by doing what? By adding. Okay, maybe you can just put it like this: is computed as follows. This is computed as what? As the follows. So here we start with basically balance brought down, and basically balance brought down. We are saying that these are the number of the ordinary shares which were outstanding. The number of ordinary shares which were outstanding. I've said the number of ordinary shares which were outstanding at the start. These are the ordinary shares which were issued and free paid at the start of the year. The number of ordinary shares issued and free paid at the start of what? Of the year. And then to this code we add the shares which were issued in course of the year. The shares which were issued in course of what? The year. The shares issued. The shares issued in course of the year. Now, the shares which are issued by the company during the current financial year, those shares basically can be broadly classified into two main categories. Number one, we have issue at a full market price, and number two, we have the issue at nil consideration. We have the issue at nil what? Consideration. So what do you mean by the issue at full market price? Now, these are those particular shares which were issued by the company during the current year at a price which is equivalent to the market price per share. At a price equivalent to the market price per what? Per share. So these shares were issued during the current year at a price equivalent to the market price. Now, issue at nil consideration, nil we know is zero. So these are those shares which are issued free of charge. And a good example of this is a bonus issue. A bonus what? Issue. A bonus issue, basically, we know that these are those particular shares which are issued free of charge. Free of what? Of charge. Now, is there any difference in terms of how we deal, or we do what? We treat the shares issued at full market price and the shares issued at full market at nil consideration. Is there any difference? Yes. So there is a difference. Maybe I can just put that here as a note. Number one, those particular shares which are issued at nil consideration. Nil consideration, I've said, are shares which are issued free of charge. Free of charge. A good example is a bonus issue. The shares are issued to the existing shareholders of the company free of charge. Now, these particular shares, these shares are not weighted on time basis. Are not weighted on time basis. I'll be able to explain what you mean by that. They are not supposed to be weighted on time basis. I will explain what you mean by that further. But now these shares which are issued at full market price, these one are supposed to be weighted on time basis. Weighted on time what? On time basis. They are weighted on time basis. Let me explain what we mean by weighing the shares on time basis. Let's assume that the financial year of a company runs from 1st January up to 31st of December. That's when the year starts and when it ends. And maybe you're told that on 1st of July here, which is basically 6 months to the end of the year, our company issued like 2 million ordinary shares, and these shares were issued at full market price. Were issued at full market price. We are saying the shares which are issued at full market price, they must be weighted on time basis. So meaning that when talk about the shares being weighted on time basis, it means that these shares should be multiplied with the proportion of time they were held during that year. They were held during that year. For the purpose of computing the one-offs, those shares should be multiplied with the proportion of time they were held during that year. For example, because these shares were issued at full market price, when adding them here, do we add them as 2 million? No. We take 2 million, and then we multiply those shares with the proportion of time they were held. So these shares, we know they were held for 6 months out of 12. So in that case, we have weighted those shares on time basis. We have multiplied those particular shares with the proportion of time they were held during that year. We have done what? We have multiplied those particular shares with the proportion of time they were held during that what? Year. They were held during that year. So all shares which are issued at full market price, that's what you need to know. They are supposed to be multiplied with the proportion of time they were held. But those shares which are issued at nil consideration, they are not supposed to be multiplied with the proportion of time. If, for example, these 2 million shares here were bonus shares, bonus shares. So when adding them to the shares issued and fully paid at the start, we add them as 2 million. We add them as 2 what? Million. We don't have to multiply them with the proportion of time they were held during that year. They were held during that what? That year. So that's basically the first thing you need to know as far as the computation of a loss is concerned. And remember here, what you have said is that the shares which are issued by the company during the current year, they are generally classified into 2 categories: issue at full market price, issue at nil consideration. But now I want us to look on how specifically we treat the different types of issues which may be made during the current year. So during the current year, the company can make different types of issues. Number one, we have the issue at full market price. I think I've already experienced that. We also have something called the bonus issue. The bonus issue. Number 3, we have something called a right issue. A right issue. Number 4, we have issue of partially paid shares. Partially paid shares. Partially paid shares. Number 5, we have issue of shares in payment of purchase consideration. In payment of purchase consideration. Purchase consideration. And number 6, we have what? We have something called the share split. The share split. The share split. Number 7, we have shares issued. Shares issued in exercise. In exercise of a stock option. In exercise of the stock option. Some of them which I've not explained here. Like I think I've already dealt with this one. So basically, we have said that these are the shares which are issued at a price equivalent to their market price. And basically, we have said for the purpose of computing the weighted average number of shares one-offs, these shares are supposed to be they're supposed to be weighted on time what? On time basis. Anytime you're told the company issued shares at full market price, you just need to do what? To weight them on time basis. They're supposed to be weighted on time basis. In other terms, we have said this means that they should be multiplied with the proportion of time they were held during that year. Multiply them with the proportion of time they were held during that year. During that what? Year. And that will also apply to these shares here. This will also apply to these shares here. And there is something I'm almost forgetting here. We have shares issued. shares issued in exercise. Okay, that is on conversion of convertible securities. On conversion of convertible what? Securities. So basically, these shares, we have said they should just be weighted on time basis. Then the same case applies to this. That is the issue of shares in payment of purchase consideration. You see, shares basically can be used by the company to make a payment. This is something you know from the topic of group account. What you did in FR, financial reporting. So you know that once the parent company has acquired the majority of the shares in the subsidiary, the parent company may pay for the shares acquired in cash, or the parent company can issue its own shares as a form of payment. So shares can be used by the company as a form of payment, can be used by the company as a form of what? As a form of payment. So therefore, once we have shares which have been issued by the company to pay a purchase consideration, how do we treat those particular shares when computing the one-offs? So the shares which are issued by the company to pay a purchase consideration, equally these particular shares are supposed to be weighted on time what? They are weighted on time basis. These ones are also weighted on time what? On time basis. They are also weighted on time basis. Usually the company can issue shares to pay a purchase consideration in a business combination. Business combination is where one company is acquiring another, like the parent company acquiring a subsidiary, or a company can purchase an asset. There is a topic you're going to discuss known as a share-based payment. We can see that, we will be able to see that once a company acquires an asset, the company can pay for that asset by issuing its own shares. So those shares which are issued to pay a purchase consideration, basically those shares are supposed to be weighted on time what basis. They are supposed to be weighted on time what basis. I'll not be able to discuss that in details. And then we also have here the shares which are issued on conversion of convertible securities. First of all, what are convertible securities? Convertible securities basically are those securities which are issued by the company but which are convertible in nature, which can be converted into ordinary shares. And this is something we came across in the topic of financial instruments. Actually, these convertible securities issued by the company, in the topic of financial instrument, we refer to them as compound financial instrument, convertible debentures, convertible bonds. Now, those are convertible securities. So the reason why we refer to them as convertible securities is because they can be converted into ordinary shares. The holders do have an option to convert them into ordinary shares. So once they have exercised that conversion right, and they have converted them into ordinary shares, those ordinary shares which will be issued to them on conversion, equally those shares are also supposed to be weighted on time what? On time basis. Those shares which will be issued by the company on conversion of convertible securities, they are also supposed to be weighted on time basis. They're also supposed to be weighted on time what? Basis. I think now I can be able to proceed and explain how we treat these other types of issues. These other type of issues. There is something I've explained in relation to the bonus issue, but I need to add something else. Bonus issue, remember you have said, this is the issue of additional shares to the existing shareholders of the company free of charge. Free of charge. So here the company issue additional shares to the existing shareholders free of charge. 2 points to note here. 2 points to note. One, these shares are not weighted on time basis. Are not weighted on time basis in computing the one-offs. So when computing the weighted average number of ordinary shares, those shares are not supposed to be weighted on time basis. So even if they're issued, for example, 2 months, 3 months to the end of the year, never multiply them with the proportion of time. Number two, in case you're given information about the previous financial year, for example, in this case, you were to compute the basic earnings per share for 2024, but also you are given information about 2023. Information about what? 2023. So basically, in this case, or let me put it like this. Assuming you're told during the current year, the company made a bonus issue. during the current year, that is the year 2024. Now we are saying those shares we don't weigh them on time basis. So in other terms, what that means is that we assume that those shares were outstanding from the start. The shares were held from the start. That's why we are not multiplying them with a proportion of time. We assume they were outstanding at the start. But anytime you're given two periods, like that case 2024, 2023, we don't assume that they were issued at the start of 2024. We assume they were issued at the start of 2023. Now that assumption has two implications. One, during the current year, don't weigh those shares on time basis. That's the first implication. Number two, because we are assuming they were issued at the start of the current year, it is obvious that when the earnings per share for this year was being computed, were those shares used? Were these bonus shares used? They were not used. And therefore, if the earnings per share for this year has already been computed, we have to adjust it. We have to adjust it simply because we are saying these shares which were issued free of charge, they were issued at the start of 2023. But we are saying when the earnings per share for this year was being computed, those shares were not used. So therefore, number two, we say that use those shares, use them to do what? To restate. To restate is basically to adjust EPS, and that is basic EPS of the previous period, or basically the previous year. How do we compute this restated? It can be known as the restated or adjusted earnings per share, basic earnings per share of this year. So to compute that one, we take the PATOS basically for this year, that is 2023. We can just refer to that as PATOS for P. P to stand for previous year. Are we together? P to stand for previous year. We divide that with the one-nos for previous year. And then out to these PATOS for previous year, we add the bonus shares, which were issued during the current year. Maybe you can just use C. The bonus shares for the current year. The bonus shares for the current year. So that is basically how we compute the adjusted earnings per share for the previous year. So we are saying we have to adjust it simply because these shares are assumed to have been issued at the start of 2023. So that is the 2 points you need to know as far as the bonus issue is concerned. Let me first of all skip this one. I'll be able to come back to that. So then let's talk about the shares issued at, or issue of partly paid shares. Issue of partly paid shares. Issue of partly paid shares. What do you mean by partly paid shares? Partly paid shares, basically, these are the shares which the company will issue during the current year. But when the financial is coming to an end, those shares are not fully paid. Those shares are not fully paid. For example, our company issued some shares here, maybe 6 months to the end of the year. And the shares which were issued were 2 million. They were issued at a price of maybe 10 shillings. But when the year is coming to an end, we are told maybe the amount which is paid per share is 5 shillings. So it basically means that at the end of the day, the shares are partly paid. So if that is the case, then when computing one-offs, weighted average number of ordinary shares, use the fully paid shares. Use the fully paid what? Shares. Fully paid shares. Use the fully paid shares. We use the fully paid shares. We use those shares which are fully paid. And basically to compute these fully paid shares, compute the amount received. How much amount was received by the company from the shares issued? The amount received. The amount received, for example, in this case here, will be equal to the shares which were issued. This is 2 million times the amount which has been paid per share, which is 5. That will give us the amount received. And then divide that with the issue what? Issue price. You multiply that with the issue price. So that will give us the shares which are fully paid. The issue price is 10 bob. Yes. And then in this case, because these shares were issued at full market price, you have to remember our common rule, our golden rule. Shares which are issued at full market price, always, you must multiply them with the proportion of time they were held, or we weight them. We multiply them with the proportion of time the shares were held. The shares were held. So I think that is basically the other or basically what you need to know as far as these shares are concerned, the partly paid shares. We have already discussed about this one. Then I want us to discuss something to do with the share split. The share split. And share split, I know this is a concept you came across in company law. Is a concept you came across in company law. Share what? The share split. Share split. Now, what do you mean by the share split? Share split basically is whereby the company will subdivide one share into two or more shares. Usually, a share split happens whereby the market price per share or the market price of the company share has significantly increased, maybe due to the good performance of the company and maybe high demand of the company shares. You may see a scenario whereby the company issued shares, maybe at a price of 20 shillings, but after 1 year, the shares are trading at 200,000. I think that happened with Equity Bank some time back. They had to do a share split. So if you issued shares at a price of 20 and maybe the market price significantly increases to something like 200, is always advisable you do a share split. A share split basically means that you may take one share, you split it into 10. So if one share had a market price of 200 and you have splitted that one share into 10 shares, it then means that the price per share will reduce to 20 shillings. We reduce to 20 what? Shillings. We reduce to 20 shillings. So basically what that means is that in case of a share split, if, for example, you held like one share, and basically this one share has been split into 10 shares, automatically that means that you have been issued with 9 additional shares. Have you paid for these 9 additional shares, or will you be required to pay for these 9 additional shares? Automatically no. So therefore, the additional shares which are issued as a result of the share split, they are treated as an equivalent of the bonus issue. They are treated as an equivalent of the bonus issue. The additional shares. The additional shares issued as a result of split, issued as a result of a share split, as a result of a share split, are treated as an equivalent. Are treated as an equivalent of bonus shares. Are treated as an equivalent of bonus shares. Now, in that case, you have to remember what have we said regarding the bonus shares. The bonus shares, number one, we have said we don't weight them on time basis when computing the earnings per share for the when computing the one-offs. And number two, we also use the bonus shares to restate. We also use the bonus shares to restate the EPS of the previous year. We also use the bonus shares to restate the EPS of the previous year. Those are basically the 2 points you need to remember as far as the bonus issue, the bonus shares are concerned. I think we are done with that. This one. Yes, let's discuss about that one, and then we finalize with the right issue. So we have the shares which are issued in exercise of stock option. In exercise of stock option. So the first thing we need to ask ourselves here is, what is a stock option? A stock option, basically, this is a privilege which is given to the employees of the company to be able to buy the company shares in future at a price which is below the market price. So an option, a privilege, which is given to the employees of the company to be able to buy the shares of the company in the future at a price below the market price. Or in other terms, the employees will be given a privilege to buy the shares of the company at a price below the market price once the employees have met certain conditions which are set by the company. For example, the criteria set by the company here may be something like the profit reported by the company. For example, if you are in charge of a certain department, you are a manager in charge of a certain, not department, rather branch, you can be told that if the profit of this branch exceeds this amount, the company will give you a privilege to buy its shares at a price significantly below the market price. Alternatively, once you secure a job with a certain company, that company can tell you that if you work with them for the next 3 years, for the next 5 years, you'll be having a right to buy the company shares at a price significantly below the market price. It is a privilege given to you, but you have to meet certain conditions. So once you exercise that stock option, it basically means that as an employee, you have bought the shares at a price below the market price. You'll buy the shares at a price below the market price. And anytime the company issues shares, anytime the company issues shares at a price which is below the market price, then it is assumed that some of the shares here have been issued at full market price, whereas other shares have been issued free of charge. That is the assumption. And therefore, these shares which are issued by the company to the employees who have exercised the stock option, those shares are split into two components. We split them into two components. Number one, shares which are issued at full market price. And number two, we compute something called the bonus element. So the bonus element, basically, these are the shares which are deemed to be issued free of charge. Free of charge. How do we compute these shares which are issued at full market price? So in this case, we first of all determine how much amount was received by the company. When the employees bought the share, how much amount did they pay to the company? And then we divide that with the average market price per share during that year. The average MPS, the average market price per share, average market price per share. And automatically, because these shares are issued at full market price, remember our rule. All those shares which are issued at full market price, we have to rate them on time basis. We have to multiply them with the proportion of time they were held. And then from there, we determine the bonus element. Bonus element are the shares issued for free, which are deemed to be issued free of charge. How do we compute this one? So to compute this, we take the total shares issued, which were issued, how many shares were issued to the employees, and then to this we less the issue at full market price. And basically the issue at full market price, this is basically what you have computed up here using this formula. Using that word, a formula. And then these shares, because they are bonus shares, we then treat them as an equivalent of a bonus issue. What does that mean? It basically means that during the current year in computation of our NOS, those shares should not be weighted on time basis. These ones are not weighted on time basis. They are not weighted on time basis. And equally, we also use them to restate, to adjust the earnings per share of the previous year. Just like what you have said, as far as the bonus issue is concerned. As far as the bonus issue is concerned, that's basically what you need to know as far as the stock option is concerned. The shares, because they are issued at price below the market price, we split them into two components. Issued at full market price, which has to be weighted on time basis, the bonus element, which should not be weighted on time basis. Now, the same concept applies to the right issue. The same concept applies to the right issue. But the first thing we need to ask ourselves here is, what is a right issue? A right issue is a concept you have covered in the other units, including FM, including FR. And basically, right issue, we know that this is the issue of additional shares to the existing shareholders of the company at a discounted price to the market price. In other terms, it is the issue of additional shares to the existing shareholders of the company at a price below the market price. At a price below the market price, just like a stock option. Just like the shares issued in exercise of stock option. So here the share will be issued. Shares are issued at a price below the market price per share. And therefore, the shares which are issued during the right issue, just like what you have said up here, these shares are split into two. One, issue at full market price. Issue at full market price. And number two, we have the bonus element. We have the bonus what? Element. So when talk about the issue at full market price, how do we compute this one? The computation is the same, but with a slight difference. With a very slight what? Difference. So first of all, we compute this one. How much amount was received by the company? And this is basically what you need to remember, the amount which was received by the company. And then do we divide that with the average market price? In case of a right issue, we don't divide that with the average market price. We divide that with something called the theoretical 𝐎𝐻 price. Theoretical 𝐎𝐻 price. This is something I know you came across in FM. Theoretical 𝐎𝐻 price. I'll be able to show you a very simple approach of computing the same, because there was a formula you were using in FM in computation of theoretical 𝐎𝐻 price. What is theoretical 𝐎𝐻 price? Theoretical 𝐎𝐻 price basically is the expected market price per share after the right issue. Once the company make a right issue, the market price per share slightly reduces. So that expected market price per share after right issue is theoretical 𝐎𝐻 price. Theoretical 𝐎𝐻 price. And because these shares are equally issued at full market price, they are supposed to be weighted. They should be weighted on time basis. So what about the bonus element? Bonus element are the shares which are deemed to be issued free of charge. And these ones, the formula for computing this is the same with this one. So we take the total shares which were issued. How many shares were issued to the existing shareholders of the company? Total shares which were issued, and then we less the issue at full market price. We less the issue at full market price. Issue at full market price is basically what we will have computed up there. And basically these ones are not supposed to be weighted on time basis. They are not weighted on time basis. They're not weighted on time what basis. I think basically that's what you need to know here. Because once you come across maybe a question, the examiner will usually test, will give you different types of shares which were issued, different types of issues. But the one which is common in all questions for earnings per share, this is something you'll be able to see. All questions for earnings per share, you'll come across the concept of the right issue. You'll come across the concept of the right what issue. Simply because two things here. Once you're given the concept of the right issue, you have to compute the theoretical 𝐻 price. Majority of the students have a problem in terms of computing what? The theoretical 𝐻 price. Number two, once you're given a right issue, you have also to split those shares into two components. The shares issued at full market price, the shares issued at free of charge. The shares issued free of charge, just like what you have said in stock option. Fred, I think you have said there is not much difference. Maybe, I don't know what is not clear here in case of a right issue, because you have said just the same with the stock option. The only difference is when computing the issue at full market price. So here you use the average market price per share. Here we use the theoretical 𝐻 price. Theoretical 𝐻 price, I've said that price will not be given. You have to compute it. I'll be able to show you a very simple approach of computing the same, because in FM, there was a formula you are using. Do you need to cram that formula here? No. I'll be able to show you a very simple approach of computing the theoretical 𝐻 what price. I hope that Fred is clear. I hope that is clear. Though no need to worry, you'll be able to understand this better as we do an illustration. Now, basically what I want us to do, take a short break, and then once we come back, I want us to do a question on this. We do a question on this. such that what will be remaining will be the concept of diluted earnings per share, which I'll be able to introduce in our next class, and also we do a question. I want us to finish this topic in the next class. Maybe if you're going to do more questions, we will do them during our revision. Remember, we say that this semester is quite short. So there are those topics we will try to rush, especially the topics which were tested last sitting, especially those topics which were examined last sitting. I think we will try to rush, though we may also come back to those topics and we do more revision. So I want us to start with this question here. This question here for August 2023. Let me see. Yes, August of 2023. August 2023. The specific question I want us to do is question 3B. Question 3B. So maybe you can just take a short break of 10 minutes, 10-minute break. Then we come back. Make sure you have that question with you. As we come back after a short break of 10 minutes. Yes. So we take a short break of 10 minutes. We come back at exactly 5:10. Make sure you have that question with you. Yes. So let's continue. I hope you already have that question with you. Yes. So what are we told here? For the year which ended 31st of July 2023. 31st of July 2023. Now, this question basically is a repetition of another question. And the other question was requiring actually the computation of earnings per share for 2 years, 2022, 2023. Let's do the same here. So we compute the earnings per share for the 2 years, but if you check on the question, the examiner was just requiring candidate to compute the earnings per share for the basic earnings per share for 2023. But let's start by computing the basic earnings per share for 2022, then for 2023. So we start with this year here, that is the basic earnings per share for the year which ended 31st of July 2022. Now, what do we need here? The first thing we must remember is the formula of computing the basic earnings per share, which is basically the PATOS, divided that with what? With one-offs. And basically, I want us to start by computing this PATOS. The PATOS. And basically, for us to be able to save time, let's compute the PATOS for these 2 years, 2022 and also 2023, because the computation is just the same. The approach of computing this PATOS is the same. Now, you have to remember, how do we compute this? How do we compute the PATOS? I've said we always start with the profit after tax, which can also be known as net income or the profit for the year. To this, we less a number of items, the preference dividends for the current year only. We also less the profit, which is attributable to non-controlling interest. And also we we add any loss from discontinued operations. So if you check on that information which you have there, there is nowhere we are given information about what? Discontinued operation. There is nowhere we are told there was a loss from discontinued operation. So let's start with this one, profit after tax. Profit after tax, when we have that below paragraph 1. where we're given the statement of profit or loss. Can we go to where we have the profit after tax? Profit after tax should be below the profit before tax, less tax, and then below that we have the profit for the period. The profit after tax for the period. We start with that of 2022, and it's also important for us to note here that our figures are in million of shillings. So this one is for 2022, that's what you're going to start with. For 2022 is 480 million. For 2023 is 650 million. 650 million. Understand? Yes. So then to that we less the preference dividend. Where do we get the information about the preference dividend? We get this from the information we have below paragraph 2. Paragraph 2, where we given the statement of financial position extract. So because in our case there, you can see our company had issued equity shares or ordinary shares, and still our company had issued 4% preference shares. And I hope you can see the examiner has specified that these are non-redeemable. So because if we were told they were redeemable, then you have said you don't less their dividend here. So the preference dividend, basically for the 2 years, will remain the same because you can see there was no any change in the preference share capital, and the preference dividend should be 4% of the preference share capital. I hope you can see the preference shares issued at 4%. The dividend to be paid each year should be equal to 4% of the preference share capital. Preference share capital is 200. And basically this will give us what? Will that give us 8 million? 8 million, will that give us 8 million? 4%? Yes, so that one is 8 million. And basically that remains the same for 2 years. And then to this, we also less the profit attributable to NCI. Do we have the profit attributable to NCI? Yes, because these are information about a group of companies. So that profit attributable to the NCI is given below paragraph 1. We should be able to go to something, or there is something you're given in that statement of profit or loss. We are given the profit for the period attributable to. Can you see that? Profit for the period attributable to the owners of the parent and attributable to the non-controlling interest. That's what we are interested with. The profit for the period attributable to the NCI, to the non-controlling interest. And not whatever you're given down there, because down there you can see we're given the total comprehensive incomes. So what we left here is the profit attributable to NCI. Profit for the year attributable to NCI. For 2022, that one is 60. And for 2023 is 90. Is what? Is 90. So take into account, we don't have any loss from discontinued operation. We should be able now to get our patos. We should be able to get our patos. So what will be the patos for the year 2022? It will basically be 480 minus 68. And that will give us 412. We do the same. We take 650 minus 98. And basically this will give us what? That will give us 552. So in our case, we already have what? We already have the patos basically for 2 what? For 2 years. So then I want us to move and we compute, first of all, we compute the one knows for 2022. And then from there, we compute the one knows for 2023. And then we compute the diluted earnings per share for 2023. But first of all, we deal with the 2022. So we compute the weighted average number of ordinary shares. Now, first of all, can we go to the last paragraph? To the last paragraph of this question. In the last paragraph, where we are given various transactions for the issue of shares, note 1, 2, 3. The first paragraph here, to during the year which ended 31st of July 2023, the following changes took place. So those changes which are given in paragraph 3 are for the second year. For the second year, they are not for the first year. So mean that during the first year, 2022, there was no issue of shares. So therefore, how do we compute the one-offs? So we're going to compute the one-offs using the information we have below paragraph 1. Can you go to not paragraph 1, paragraph 2? Below paragraph 2, where we have the statement of financial position. Can we go to the statement of financial position for 2022? So we are given the statement of financial position for the year which ended 31st of July 2022. We are saying we have 2 years, 31st of July 2022 and 31st of July 2023. This is the first year, the second year. So we are computing the basic earnings per share for this year. We have managed to compute the one-offs, the patos. We want to compute the one-offs. I hope you can be able to recall what we said as far as the computation of this is concerned. We take the shares which were issued at the start, and then we add the other shares which were issued during that year. But basically what you have said is that the information we have in below paragraph 3, those are the shares which were issued during this year. So during this year, there was no issue. There was no good issue. If there are no shares which were issued during a certain year, the shares issued at the end of the year and the shares issued at the start are the same. And basically that is always your one-offs. That is always your what? Your one-offs. So if you're given, because you'll also come across other questions whereby you're just given shares issued at the end of the year, you are told during that year, there are no other shares which were issued. It means that these shares issued at the end of the year are the same shares which were issued at the start, and therefore that would be your one-offs. Because the shares issued at the start, you have them. Were there some shares which were issued during that year? No. So therefore, in case you come across that question, then it is important for you to remember that. So therefore, can we go to the information we have below paragraph 2 and we determine how many shares had been issued at the end of 2022? So we will take the ordinary share capital of this company or the equity share capital of the company, which is basically given as 400 million. We divide that with the par value per share because this is the value of the shares issued. Can you be able to see the par value per share? The par value per share is 0.5. 0.5, that one is within our statement of financial position. We are told the company had issued, or the ordinary share capital of the company is 920 and 400. And inside the bracket, you're told the par value per share is 0.5. Are we together? Yes. So meaning that here, the shares which were issued at the end of the year were 800 million. 800 million. And take into account during this year, there were no other shares which were issued. It also means that the shares which had been issued at the start here were 800 million. So therefore, in terms of how we compute this, we say that the shares which had been issued at the start, automatically this year, the next year here will start 1st August. So this year started 1st of August, 2021. The shares which had been issued, we refer to that as the balance brought down, were 800 million. 800 million. Our figures here are in million of shillings. These are not shillings because these are specifically the number of shares. Specifically the number of shares. And then during that year, there were no shares which were issued. In fact, we can just confirm that from the information we have below paragraph 3. So the first transaction, number 1, there were 200,000 shares which were issued. If we go to the last sentence, the issue took place 1st November 2022. 1st November 2022 is within the second year because the second year started 1st August 2022. 1st November 2022 is within the second year. Number 2, that one is, I think, is a right issue, but we will be able to see it was made on 1st Feb of 2023. 1st Feb 2023 is within the second year. Number 3, 31st July 2023, the company make a bonus issue. You can see that is still a transaction for the second year. So during this year, 2022, there were no shares which were issued. So it basically means that the weighted average number of ordinary shares there were no for this year is what? Is 800,000. Is 800,000. Is 800,000. 800,000. And I think in our case, we are basically done. We are basically through. We are basically through. So what we need to do, yes, a question, who is asking a question here? So 200 in conjunction with acquisition of another business. No, and we are saying when did the first year ended? Because that's what you need to understand. And mwaka ya kwanza iliisha lini hapo? An iliisha 31st July. Kwa hivyo 1st November 2022 hiyo ni mwaka ya pili. Is that clear? Sioni mwaka ya pili. 1st November 2022 should be the second year. The first year ended 31st of July. So 1st November ni mwaka ya pili. Sawa? Yes, yes. So in our case, I think now we can move and compute the what? The basic earnings per share by basically applying our formula per TOS, this one, 412. And remember all our figures are in million of shillings, all of our one-offs, which is basically 800. And this will give us what? This will give us what? Let's try to add it so that we finish on time. We have 412 divided by 800. And basically this will give us 0.515 per what? Per share. 0.515 per what? Per share. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Now next, let's compute the basic earnings per share for 2023. For the year which ended 31st of July 2023. So remember, you have already computed the per TOS here. So what we need to compute is just the one-offs, the weighted average number of ordinary shares. So in this year, we have a number of transactions which took place. So what we do, we start with the shares which were issued and fully paid at the start of the second year. So the second year, we know the first year ended 31st of July 2022. The second year, you see, started the following day, 1st August 2022. So 1st August of 2022. So the first thing we need to do here is to determine how many ordinary shares or equity shares had been issued and fully paid, were issued and fully paid at the start of the second year. And remember, our figures are in million of shillings. Now, that is something which the examiner will not have given you, especially whereby you have 2 years, which are you have 2 years which are following each other. So because automatically the shares now which were issued and fully paid at the end of 2022 will be the opening shares in 2023. You see, at the end of 2022, the company had issued 800 million shares. So those will be the shares issued and fully paid at the start of the following year. Are we together? Yes. So the shares issued and fully paid at the start of the second year are 800 million. So then to this, what do we need to do? We need to add the other shares which were issued within the second year. We have those shares in note number 1, 2, 3. So let's go to note 2. Let's go to note 2. In note 2, we have 200 million equity shares were issued in conjunction with acquisition of another business. These are shares issued in payment of a purchase consideration. These equity shares were issued at full market price at the date of the issue, which is 1st November 2022. 1st November. And I hope you can see how I'm recording all these transactions. I'm starting with the date, a short description, and then the amount. Or the number of shares, not the amount, the number of shares. So here we have shares. We can just refer to this as issue of shares at full market price. So the shares which were issued here were 200 million. And then you have now to remember what you have said in relation to the shares issued to pay a purchase consideration or the shares which are issued at full market price, because these are shares issued to pay purchase consideration. We have said such shares should be weighted on time basis. Multiply them with the proportion of time they were held. You can see those shares were held from November all the way to the end of the year. And tunajua mwaka inaisha 31st of July. So Fred, you're saying 2 months. No, those shares were held from November to 31st of July. Those are how many months? They are actually 12 months. We exclude which month? We exclude August, September, and I think October. Yes, I think we exclude 3 months. Yes, so this should be 9 months. We have November, December of 2022, and then in 2023 we have January all the way to July. So those are 7 months. 7 months in 2023 and 2 months in 2022. Those are a total of 9 months. So we multiply this with 9 all over 12. 9 all over 12. So this will give us what? That is basically like 3/4. And basically that will give us what? 150. Is it coming to 150? Is it 150? Is it 150? Yes. Yes. So that's basically how we treat those shares. Let's go to note 2. Note 2, we are told 300 million ordinary shares were issued for cash to the existing shareholders. Anytime you see an issue to existing shareholders and it is for cash, this is a right issue because shares can be issued to the existing shareholders in two forms. It can either be a bonus issue, it can either be a right issue. But because the shares here automatically are issued for cash, these are not a bonus issue. So were issued for cash to the existing shareholders on 1st Feb 2023. 1st Feb 2023. 1st Feb, the issue price was 1.5 per share, which was represented 25% of the traded market price before the time, which was 2 shillings. Now, this is the issue of additional shares to the existing shareholders of the company at a discounted price to the market price. So the examiner here was not specific, but it's obvious, it's upon you to know that these are right issue. These are right what? Issue, because you can see it meets all the features of a right issue. The shares are issued to the existing shareholders, and number 2, they are issued at a price below the market price. So these are right issues. These are right issues. These are right issue. Now we have said that in addition to the right issue, or once we have shares which are issued during the right issue, we need to split these shares into 2 components. Issue at full market price. And number 2, we compute the bonus what? We compute the bonus element. We compute the bonus what? Element. But basically, before we do that, there is something we need to compute here. And basically, that is something we have referred to as the theoretical X-rate price. The theoretical X-rate price, we have said, is the expected market price per share, after the right issue. So there is a very, very simple approach of computing this. Very, very simple approach. First of all, we determine how many shares had been issued by the company before the right issue. Before the right issue, how many shares had been issued by the company? You can't get that in the question. You can only get that from our question here. How many shares had been issued before the right issue? The shares which had been issued by the company before this right issue were 800 plus the shares which were issued here. Hapa ni shares ngapi zilikuwa issued? Who can tell us? How many shares were issued here? I'm told by Fred they were 150. Hapa ni shares ngapi zilikuwa issued? And Edith, Patrice, yes. Shares zenye zilikuwa issued hapa sio 150. Hapo unachukua the actual shares which were issued. The actual shares which were issued ni ngapi? Ni 200. That is another trick. If you take 150, you get it wrong. So the shares which were issued before, because these shares, remember, they have already been multiplied with the proportion of time. The actual shares issued were 200. So you take this plus this. So the shares which were issued before the right issue, zilikuwa 1,000. 1,000. And what was their market price per share? The market price per share, this one, we have it in note number 2. So the market price per share before the right issue was 2 bob, was 2 shillings. Are we together? Yes. And then how many shares were issued by the company during the right issue? During the right issue, as per note number 2, the company issued 300 million shares at a price of 1.5. At a price of 1.5. Sasa ukikuwa na hizo values, ukikuwa na hizi figures, to compute the theoretical X-rate price becomes quite simple. And this is the same approach you're using in FM, is only that I want us to avoid the formula. I want us to avoid cramming the formula. So what you do here, take the shares which were held before the right issue. This one, 1,000. 1,000. You multiply them with their market price, which was 2. I hope you can remember something related to this. You did something related to this in FM. And then you take the shares which were issued during the right issue. This one, 300 million times the issue price. Times the issue price. Are we together? And then divide that with the total shares which were issued before and after. The shares issued before the right issue, 1,000, plus the shares issued during the right issue, 300. That is simply how you compute what? The theoretical X-rate price. The theoretical X-rate what? A price. So let's finalize on this. So we have this one is 2,000, and this is 450. 2450 divided that with 13. I hope that is what you're getting. Yes, I'm getting something close to that. 1.885. 1.885. That is now called the theoretical X-rate price. Always in these questions for theoretical X-rate price, there is a mark for that. There is a mark for this. So having that, we come back here. We split these shares. Remember the formula. We have said to compute the shares issued at full market price. Compute how much amount was received by the company from the right issue. The amount received from the right issue will be equal to the shares issued during the right issue, 300 million. 300 million times the issue price, which is 1.5. And then we divide that with the theoretical X-rate price, which we have computed there, 1.885. And then these shares must be weighted on time basis. They must be multiplied with the proportion of time they were held. These shares, remember, they were issued from Feb. They were held in Feb, March, April, May, June, July. They were held for 6 months out of 12. 6 months out of 12. So let's work out that 300 times 1.5 divided by 1.885 divided by 2. What are you getting here to the nearest whole number? The nearest whole number, what are you getting here? 118, eh? 118. Is that what you're getting? Yes, 118. So then we compute the bonus element. Remember the formula. We call the formula. You have said we take the total shares which were issued during the right issue, which are 300, minus the issue at full market price. The issue at full market price is not what we have here, but basically this is how you compute the issue at full market price. 300 million times 1.5 divided by 1.885. I usually advise the student, can you repeat what you have here? Majority of the students take this, which is basically wrong. You should take this before multiplying that with the proportion of time. And then you also have to remember that these shares should not be weighted on time basis. The bonus element should not be weighted on time basis. 300 times 1.5 divided by 1.885. We left that from 300. And that will give us 61 million. 61 million. Are you getting that? 61 million. 61 million. Yes. So basically that's how we did with the right issue. And I've said these are concepts you'll come across in all questions for earnings per share. In all questions for earnings per share, you'll come across that concept. So it's better you understand how we deal with that, especially how we compute the theoretical X-rate price and how we do that split. Finally, note 3, we're told that on 31st July 2023, the company made a bonus issue. 31st July, not 31st July 2023. Is that the end of the year? Is that the end of the year? Yes, actually, that is the end of the year. So our company made a bonus issue. Now, those shares automatically, you have to remember that, or in this case, it's important to note that these shares will have to be considered here because they were issued during the current year. And basically, what you have seen is that such shares, are they supposed to be weighted on time basis? No. These ones will not be weighted on time basis. The shares which were issued here were 540. So we are told the bonus issue of 540 million were completed capitalizing to 70 million. So in other terms, you see, anytime the company make a bonus issue, those shares will have to be paid by the company from the existing reserves. What is the total value of these shares? The total value of these shares is 540 And I hope you can be able to remember the par value per share. Can you be able to remember the par value per share? The par value per share, which we have in our statement of financial position, can you remember that par value of 0.5? Yes. You multiply that with 0.5. So the value of these shares is 270 million. So these 270 will be paid by the company from the reserves. And actually, we are told the company paid for these shares using the retained earnings. So what we use here is not the value of the shares, we use the number of shares. The number of shares. And basically, this one, we don't have to wait them on time basis. And I think in our case, we are done. So what we need to compute now is the weighted average number of ordinary shares. We basically add all that, whatever you have here, from 800 all down to 540. So you have 800 plus 150 plus 119 plus 61 plus 540. And basically that will give us what? That will give us 1670. 1670. 1670. I hope that is what you're getting. So having done, we then finalize by computing the basic earnings per share. We take the PATOS, which I've already computed here, 552 million divided by 1/2, which we have here, 1670. This will give us what? 552 divided by 1670. It will give us 0.331 shillings per what? Per share. Shillings per what? Per share. Shillings per share. Okay. Yes, I hope you're getting that. I hope you're getting that. Are you getting the same value? Are you getting the same value? Are you getting the same value? Yes. Now we do the last part. The last part, what are we required to do? We required to compute the comparative figure for 2022 to be reported in the year 2023, given that the EPS, the earnings per share figure originally reported. Okay, that is not important. Basically, what you're required to compute in Roman 2, we are required to compute the restated earnings per share over 2022 as at 31st of July 2023. So we are required to adjust the earnings per share of the previous year. So we are required to adjust the earnings per share of the previous year. Now, if you check on the earnings per share which are given in that question, in that part, Roman 2, we are told the earnings per share for 2022 was 0.525. But I hope you can see what you have gotten here. I think that question, even the other question, because this was a repetition, that is the same figure. But I think there was a problem with this figure because you can see the earnings per share for this year should be 0.515, not 0.25. So now we are required to restate, to adjust this. The first thing you need to remember is why do we adjust the earnings per share of our previous year? Remember here we have 2 years, 2023, 2022. So we adjust the earnings per share for the previous year in case during the current year, there are some bonus shares. There are some shares which were issued free of charge because you have said such shares are assumed to have been issued at the start of the previous year. And if you check on what you have computed here, you'll be able to see we have some bonus shares. Like number one, we have these 540. So those shares will be assumed to have been issued at the start of 2022. Do we have another bonus element? Yes, we also have this one. So that's why we have to adjust the earnings per share of the previous year. Recall the formula which I've given you for adjusting the earnings per share. I've said we take the PATOS, and I hope you can remember this for the previous year. Or in other terms here, we will take the PATOS now for the previous year, which is 2022. We divide that with the 1/2. Also for 2022. And to this, we add the bonus shares, which were issued during the current year. That is 2023. So if you have that formula, then it becomes very, very simple. It becomes very, very simple. The question becomes very, very simple. So because we have all the figures now, provided you can remember that. So the restated earnings per share, we will take the PATOS for 2022. We have those values here. This is basically the PATOS, the 1/2 for 2022. So the PATOS for 2022 is the 412. The one-offs for 2022 is 800. So we have that, And then out to this, we need to add the bonus shares, which were issued during the current year. And we have that here. So we have this bonus issue, and also we have this bonus element. Those shares which you have not weighted during the current year, they must be used in terms of restating the EPS of the previous year. So to this, we will add 61, this one, and also this, and also that 540. And basically, we get what? The restated earnings per share for the previous year. So the restated earnings per share for the previous year will be 412. Okay, we have 800 plus 61 plus 540. So we take 412 divided by answer. And basically, I'm getting 0.294 shillings per share. So can you confirm whether that is the value you're getting? Is that what you're getting? Is that the value you're getting here? Yes, 0.294. 0.294. Yes, so basically that is it, that what was required there. That is what was required there. I'm trying to check the other question because I've said there was a repetition of another question. This was a repetition of another question which was examined some time back. Okay, can I see the other question? Okay. And what is not clear on the right issue? What is not clear on the right issue? What is not clear on the right issue? November 2018. Yes. So this was a repetition of that question, which was examined November 2018. November 2018, question 5. Question 5. Hapo kwa theory. Okay. So let us do another question because you'll also be able to see the other question. Tutatumia approach tofauti. So basically what we do, tunachukua the value of the total. Actually, this one we refer to it as market capitalization. Market capitalization ni value ya shares zote zimekuwa issued na company. I hope you can see what we have done. Tumechukua zile shares zilikuwa issued before, we have multiplied them with their market price. That is called market capitalization of the share. The market value of the shares issued before, you add the value of the shares issued during the right issue. Basically, that's what you have done. And then you multiply that, you divide that with the total shares which were issued. That should give you the market price of each share after the right issue. But you'll be able to understand better. Once we do another question, you'll be able to see still we will use another approach. But the concept is this. Unachukua zile shares zilikuwa issued before times their market price, and then zile shares zilikuwa issued during the right issue times the issue price. You add that value, and then you divide that with the total shares which will have been issued after the right issue. So the only tricky part ni kama hapa sasa. Ungechukua hii 150, it basically means that you are wrong. Lazima we work na zile the actual shares issued before, which will be 800 plus 200 shares. Sasa, yes. But basically, no problem, because I think we will do another question on this. Maybe you'll be able to understand. You'll be able to understand that. Sasa, yes. So I think for today, we're going to stop at that point. There are so many questions on this from those past papers, including our sitting. But if you check on most of the questions, they require the computation of both basic and diluted. So the question, for example, which I've given here is purely on a basic. I don't know whether the other question which Fred is proposing here do have the aspect of diluted. But once we meet now in our next class, what we will do, we will look on what is diluted earnings per share. What is the diluted earnings per share? We look on the steps which are involved in the computation of the same, and then we finalize. We finalize by doing a question having both the basic and also diluted earnings per share. Yes. So I want us to stop at that point. I don't know whether there is any question. I want us to stop at that particular point. Is there any question before we wind up? Any question before we wind up? Any question before we wind up? Awesome. So I think there is none. So let's stop at that point. But equally, you can also check on this question. It's basically similar to this one. Yes. So have a nice evening. We continue from there on Tuesday.
Starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms? Because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest Let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 3, what? Not 3, but 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus R power n. Principal times 1 plus R power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus R power n. This factor here, this factor 1 plus R power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus R into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. We should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus r power n. So future value is equals to 100,000 times 1 plus 0.2 power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us no? No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply because we are only investing 1. So you can continue. You grow by that rate. So just this. Any question before we continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R, 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shillings 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period. Period. 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus r power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus r. 1 plus r. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the hand illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you. So just check whether you're getting the same. On 76 to 34. Point. You can round off. In this case, you can round off. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34. 157, 352. 157, 352. Next. 144, 93. 144, 93. 125 for 40. 125 for 40. And 112,000. So get the sum. $711, $519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting, or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So, how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R% power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. Just check on your WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting, I have shared. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one you're going to do in an illustration. So what do you need to add here? Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor, R% power n. So this factor here, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor, R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative N. Power negative N. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power N. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we are together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages: 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity, r% power n. Present value interest factor of an annuity, R percent power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity R percent power n. R percent power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B. If you're there, you'll see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, present value of annuity is equals to the annuity times 1 minus 1 plus R power n over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We're waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Therefore, present value of annuity is equals to annuity times present value interest factor annuity R percent power n. So here 1,000 times present value interest factor, annuity, 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% you up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah? Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that you've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather, have a good night. Have a good night.
here. Okay, welcome, Ambuche. I want to know where we left last week. I'm a little bit confused on the last question we did. But in case you're not able to remember, we can look at this paper. On April 2023. So this is a very interesting paper, and this question one had this particular question, and the question asks, highlight 5 benefits of using committees in decision making within an organization. So basically, a committee is a group decision making. Committee means you don't decide on your own, you decide as a group. A committee is basically a group decision-making method whereby you sit down and discuss. So you're asked, what are some of the benefits of group decision-making as opposed to maybe what? Individual decision-making, whereby what? You make decisions on your own. Now, the first benefit there is diverse perspective. Like now we are 5 in this class. If I was making decisions alone, then basically I'll only have one perspective, which is my perspective. But if we are 5 and each one of them gives us an idea, then we'll have 5 different perspectives. So being in a group helps you to understand other perspectives that you are not able to know. So that's number one. We talk about what? But diverse. So the committee consists of members from different departments or backgrounds, allowing for a variety of opinions, which lead to what? Well-rounded decision. Means when you have diverse opinions, then basically it means that you can now look at issues better and then what? Make good decisions, as opposed to you alone making decisions. Then number 2, is improved accuracy. Why? Because you make decision what? Collaboratively. You can never go wrong with a group. If your people are very objective, then basically a group decision making becomes the best. So that collaboration increases the chances of identifying potential flaws or risks, leading to a more informed and accurate decisions. So we talk about what? Talk about collaboration. Means because you have experts in different areas, that means that when you're going to make a decision, all of them will have their input, and their input will lead to you making what? A very accurate decision. The third benefits of group committee decision making is basically increased acceptance of decisions. If I make decision alone and then I go to a group of people and tell them that this is what I've decided, they'll ask me, you decide as who? But when I say that this is what we decided, like for example, this is what we've decided like as a country, but this is what Kenyans have decided, you will rarely refuse that decision. This is what we have decided as a class, as a company. So basically, when group decisions are made in terms of a group, then basically its acceptability rate is higher than what decision made at individual level. Number 4 is what? Pooling of experts. Sometimes we will make what we call a multi, or we call it a group with different experts. How do you call it? There's a name that we call that group, a group that has got a committee that has got different people from different departments. You have a marketer there, you have a procurement person there, you have a lawyer there, you have an HR expert there, you have a production expertise there, you have a company engineer there, you have. So basically, when you talk about pooling of expertise, so some decisions don't need only one expert. They need, for example, they need an input from the accountant, an input from procurement officer, an input from the marketer. So basically, when you can form a committee with different experts. We call it a multi-sectoral committee where you have people from what? Different sector or sections, and then they come and what? Make a committee. And that committee basically, if you're deciding on something, you'll have experts from all over. So basically, their input will go to what? Help you make what? A good decision. Number 5 is checks and balances. So group decision making helps to counterbalance individual biases or authority dominance from promoting fairness and accountability. Now, I talk about checks and balances. Sometimes there are what's called individual bias. Me as an individual, my decision is going to be biased based on my perspective, my experience, other things. But if you sit down as a group, then basically we are able to discuss even the biases that come out of my decision. The group members are able to scrutinize them. So basically, I'm going to be objective, not subjective. Anytime we have biases in decision making, we are becoming subjective. So with other people are going to scrutinize my decision so that's number 1. And then also talk about what? Authority dominance. There are some people that normally believe that they're the people that decide things. I'm the manager here, I decide. So with group decision making or with committee decision making, basically, we eliminate that aspect of what? Of authority dominance, that you're the person that makes decisions. So basically, it encourages what? Collaboration, so that even the manager feel like is also part of the organization. The next question here is asking, identify 5 ways in which management could overcome employee resistance to change. This question, as we have met it again and again and again, and you may even meet in exam. The questions repeat themselves sometimes, basically. So that identify 5 ways in which management could overcome employee resistance to change. We said that sometimes employees resist change. And there are reasons that there is change. One of the reasons, the major reason to it is what's called fear of unknown. Sometimes decisions can be made, or some changes can be made, which can even render you jobless. Some of them can lead to your job being taken away. Some can lead to your salary going down. So some can lead to a lot of things. Some can lead to relocation. You'll be used to Nairobi. You don't know you're going to Wajir. You're going to Kajiado. You're going to Kapedo, to Rukana to do work there. So basically something. So because of the fear of unknown, some people can work. So let's look at some of the ways to what. As a manager, you can be able to overcome change. This question we asked several. So this is repeated. Number is what? Effective communication. You tell me why the change is important and why. So let me know. Sometimes we resist change out of ignorance. But if you're able to communicate with me, elaborate for me, make me understand, then basically I'll be one of the people that are going to fight for the change to happen. So clearly explaining the reasons for change and the benefits of this help in reducing what? Misunderstanding and anxiety. So explain to me, in terms of my job, after the change, what's going to happen to me? If you explain and find that, oh, this thing is just for the help, for the betterment of my job and the company, and there's no harm in it, then basically we'll be able to what? Just support the change. Number 2 is employee involvement. That's very true. Employees want to be part of the changes that you make in the company. Let them be in the committees. If you want to bring a committee of a certain change, let your employees be among the committee members. Let's discuss issues. Go for some meetings, long-term meetings, maybe for 3 months, and then they understand, and then basically it's able. So when employees are part of the decision, basically they know, they understand it better. So that means what? They're able to basically support it, so the change. Number 3 is training and support. That's very true. Some changes come up with the new things that maybe your current employees don't have. They may require some new skill that the current employees don't have. So what happens? Before you implement the change, train them on the new skill required once the change is implemented. So basically, that's very important because some people fear that their job may even go, because if you bring a system that I don't know how to use, and I'm supposed to work, then what happens? I'm not going to meet my objective, and then basically I can even be fired. Now, first, what? Addressing concerns. Sometimes when you propose a change or you bring a change, employees will have their concerns concerning the change. So that's why, as a manager or as a change maker, you must be able to come up with ways of addressing. If somebody comes up with an objection to the change, and they tell me, I'm not supporting this because of it. Can you be able to address the concern? Tell them that, okay, I understand your concern, but this change is not going to harm you in a particular manner. This is what's going to do. So basically, by addressing the concern, you're able to prevent, you're able to reduce resistance to change. And then number 5 is incentives and rewards. So offering recognitions, All incentives encourages employee to embrace change positively. You have like, you can say that word, the people that help implementing them, the facilitators basically, those who are facilitators of the change, they will be recognized as by the company, they will be rewarded, or they will be what? Given some incentive. So that is very, very important that you look at that. I can see somebody has written something. Let me see what has been written down so that we can be able to help. Then incremental implementation, that is very true. We say that bring change in piecemeal. Don't just come and say that by tomorrow things are changing. No, bring change in piecemeal. So that this change we are starting, we want to implement this change departmentalized. We start with the HR department, we go, by the time we are in May next year, the company needs what? All of them needs what? We need to have what? A complete change. Don't bring what's called instant changes. That one can bring problems. So what do you do? Implement it incremental. Incremental means you do it in stages, stage 1, stage 2, stage 3. So, or what, in phases, phase 1, phase 2, phase 3. So that what people even see how good it is before even it reaches their department. That's also good. Buchi, thank you for that. And also what? Strong leadership. You must have leadership who are people who are able to stand firm and explain to employees the need for the change, and look at the interest of the company as opposed to what? Interest of individuals sometimes. Very, very true. And then follow the change management process. Yes, you can use different philosophies or different procedures in that one. So if you follow those processes well, then basically you're able to ensure that what? The changes. So those are other 3. So we were asked about 5, but we have been able to what? Come up with around 8. That means at least now we are very much armed. If you're able to have 8 points instead of 5, that is a very good sign that we are now very much armed for the sake of the exams. Now, the second question, so another next question says, explain 5 uses of business plan. This one also, we have done it before. If you look at the past papers you've done, then you'll find uses of business plan as one of the major questions that you've done. Now, a business plan is basically a proposal of what you're going to do. A plan is what you're going to do. So basically, you can call it business proposal or a business plan. It tells us basically what you want to do. That's called a business plan. Now, number 1 is what? Securing funding. Sometimes there are people that have had great business ideas, but they don't have funding. So what do? They develop a very good business plan. They develop a very, very, very nice developed business plan. And then they go to these commercial banks, whether Equity, KCB, Standbank, or Standard Bank. They go to those banks and then they book a presentation with the top level management or the management of the bank. And then they go and present their business plan. And if the bank sees that this guy has got a good business plan, then basically they'll finance you. So you have zero money, but you have a very good idea. And if they see practicality in that business, if they see that this is able to be able to get return on investment, then basically they'll be able to give you finances. So that one happens to the banks or other financials. There's been a problem called Lounsden. I don't know if it's still there. There's a problem called Lounsden in NTV. Is it still there? Whereby you see some people with business ideas go and present them before some of the managers or people, investment experts in KCB, and then they are being financed. Then in the global perspective, you used to have something called Shark Tank, whereby even Donald Trump used to be a panelist there, those people with a lot of money. So you go there, present your idea, and then they say that, okay, we are giving you money, but we want to have 40% stake in your business, but the finance. So basically, those are aspects. Now, number 2 is what? Guiding business operation. Anytime you have a plan, when you talk about this is my plan for the day, then you have to work with the plan. So basically, a business plan will guide business operation because everything you do it as per the document business plan. So basically, you're able to ensure that what your operations are guided. So it serves as a roadmap outlining goals, strategies, and timelines which guide daily and long-term decision making. So basically, you don't work against things, you work as per the business plan. And then number 3 is performance measurements. That's very true. Means in your business plan, you even have what's called projections, cash flow, projected cash flows, you have projected profits, projected balance sheet, and all. So basically, with those projections, if you do business in the first year, you can compare with what you had projected in the business plan and see whether you're moving in the right direction, or if you miss it, why did you miss it, basically. And then our four is what? Risk management. So in the business plan also, you must have something called risk management plan. Business plan has got several sections. You have the introduction part, bibliography, or the summary. We have the business plan, financial plan, management plan, operation plan, financial plan. And so basically, we talk about risk and even risk management plan. So in your business plan, you must also be able to predict some of the risks you're likely to face in the business. Because if you go to present to these banks concerning a business, they'll ask you, what are some of the risks that you identified, and how are you going to deal with them in case they come? If we finance you and then these risks come out. So basically, you must have what? A risk management plan. So that what? Any risk that may come, you already have a way in which what you want to deal with it. Number 5 is what? Is attracting strategic partners. There are people that can come on board in your business to even finance you because of what? They see you have a very practical and a very, very innovative business plan. So they want to be part of it. So basically, some people have been able to get partners to partner with them because of what? Out of the good business plan they've been able to what? They've been able to have. That is very, very important. Or very, very important. Now, question 2. Question 2 is asking, summarize 5 responsibilities of a project manager. Today, you are a project manager. And last week we said that we were doing a questionnaire, I think it was on Thursday, where we said that what are the advantages of taking tasks given to you as a project? So anytime you're given an assignment to do, look at it as a project. And if you look at it that way, then basically you'll be able to what? You'll be able to perform better. Now, let's look at this question. Summarize 5 responsibilities of project manager. You'll be given a project. You see that a project is a temporary endeavor with an objective and a starting date and an end date, basically. Now, a project manager, number 1 is what? Planning and scheduling. You have to plan for the project, and schedule means you have to say what is supposed to be done today. You schedule your activities. So as a project manager, you're given, for example, construction of road as a project. You must have what's called, you must plan what's supposed to be done, and then also schedule that. For example, how after 1 week, where are we supposed to be? Or what should you do in the first day, second day, third day? You schedule those activities. Number 2 is what? Resource management. You've been told that, okay, this road from here to here is costing taxpayers 100 million. That 100 million will be given to you as per the budget. So it's upon you to ensure that what? You manage that resource, which is, so you, as a project manager, you'll be required to manage financial resource, which is one resource, human resource, and even what? Capital resource, and even time as a resource, you manage them. Then number 3 is what? Monitoring and control. So tracking progress, managing risk, and ensuring the project stays within scope, budget, and schedule. So basically, you're able to what? Monitor, ensure that everything's done the way it's supposed to be. Then another duty or responsibility of project manager is what? A team leader. As a project manager, the buck stops with you. If the project fails, you'll be the first to blame. If the project fails, so basically, you're a team leader. You lead all the teams, different teams doing different activities within the projects. And then number 5 is what? Communication. As a project manager, basically, you have the responsibility of what? Communicating to the project team, communicating to the stakeholders, communicating to anybody within the world, anybody with an interest in that project. So communication. So keeping stakeholders informed of the progress, changes, and issues throughout the project life cycle. So it's upon you to your information is supposed to provide relevant information to the stakeholders involved. Next question here is asking, explain 5 reasons why project management is important. Now you see, we have talked about just a project management. So this paper was very nice. If you are good in project management, you score 10 marks very easily, because the previous one, how many marks was this previous one? This question was very fair. I don't know what has happened. What has just happened? What has just happened? Just a minute. Okay, good. So, reasons why project management is important. One is what? Is improved efficiency. So structured planning and execution leads to what? Effective use of time and resources. So basically, project management ensures that what? The resources that are given to the project are used in the most efficient manner. Number 3 is what? Clear focus and objectives. Now, if you are good in project management, you ensure that whatever you do it to ensure that what? At the end of the day, you should be able to achieve the project objectives or strategy. Number 3 is risk mitigation. So it identifies potential problems early and provides mechanism to manage them. So as a project manager also, you do what's called risk management. So you should be able to what? Identify some of the potential risks you are likely to face in the project and then come up with what? Some mitigation or some management strategies of those risks. Very, very important that you look at that. Then number 4 is budget control. Very true. Budget is basically, when you talk about a budget is a financial control tool. When you're budgeting means you say that this is the amount of money I have. Now this is how I'm going to use it. Without a budget, you'll do what we call impulse purchase. You purchase things you see, not things you need. There are things that you want and you don't need. There's something, the difference between a want and a need. So if you don't have a budget, then you buy things you want. You should be able to buy things you need first, then things you want can now come later. So the through constant monitoring, it helps in keeping the project within the allocated financial resources, means what? Within the budget. Number 5 is what? Stakeholder satisfaction. So successful project delivers increased confidence and satisfaction of clients and stakeholders. So basically, with good project management, you'll be able to meet the objective or the goals of the project, and all the stakeholders are going to be happy with the project. So that is the 5 reasons why project management is very important for organizations. Reasons why project management is important for actions. The C part of that question is asking, explain 5 factors that may influence the level of compensation and the benefit package offered by an organization. That means that question is just asking is in simple terms is asking what factors determine how much you're paid by the company. That's what they're asking. Number 1 is industry standards. So there's also what? The industry standard whereby a lawyer who has come out of school or a new graduate, how much? So there's another which one is in the industry. So basically, if you are new in the industry, they look at the standards and then they pay you as per that one. Number 2 is what? Organizational financial capacity. If a company is making good amount of profit, then basically they are likely to pay you highly than a company making less profit. So basically, the more profit a company gets, the more they may be able to make the life of their employees better by paying them increasing by having what's called a payment increment or salary increments. Number 3 is job complexity and what? Responsibility. So it depends. If you have a complex job, you are likely to pay more than somebody with less complex jobs. So basically, so jobs requiring high levels of responsibility, scale, or risk typically attract higher compensation. Now look at, for example, being a doctor. You know, a doctor, there's what's called a high level of responsibility. You make a small mistake, somebody may lose their life. So those ones. So basically, look at that. Then number 4 is what? Employee performance and experience. Sometimes you're paid based on performance, especially in the marketing sector. So talk about that. We talk about aspect of what? Of performance and also what? Experience. So that you've seen it happen that somebody with with many years experience are normally paid more, even at the same job. If they come to your company, that's how many years experience? 10. Then you see them being paid more than somebody at the same level because of the experience. Then number 5 is called labor market conditions. So what are the prevailing conditions in the labor market? So high demand for certain skills may push employer to offer attractive packages to secure top talent. So sometimes talk about what? Talk about market condition. If you have less accountants in the market, and there are so many companies that need accountants, then accountants will really choose that mimi nitaenda kwa kampuni ya pesa mingi, so I'll go to the company that will offer me the best package, the best employment package. So that's another factor that determines. So talk about labor market, and even I think even the industry. This one should not be is not here, but basically industry. Which one do you think is another factor that determines how much somebody is paid? Apart from this one listed down, I think the industry. There's some industries that are paying well. What else do you think are some of the factors that determine how much somebody is being paid? I think even wage bill is called talk about what? Talk about minimum wage requirements. All those one will determine how much somebody is paid. So, which other factor do you think determines how much somebody is paid in a company? The floor is open. Anybody with another factor that determines how much somebody is paid in a company? What about academic qualification? Somebody with a master's or a PhD in a particular field. Management level means where you are going to. That means what? We talk about the level you're coming at. Is it mid-level, lower level, higher level? Yes, well, that can happen. I think even academic qualifications, sometimes when somebody has got some qualifications, you feel very awkward to pay them less money. You want to justify. That's one. Another one. Any other one? Terms of contract or some terms of payments. Some are called paid wages, some are paid salaries. So basically, we have so many, but those ones are few of them that we've been able to list. Next question. The next question asks, explain two limitations of budgeting as a tool of control in a company. So basically, a budget is a financial control tool. When you give somebody a budget means what? You have to spend the money given to them as per the budget. So basically, it controls your spending. So you're being asked, what are some of the limitations of budget control? Number one is rigidity. If I give you a budget, then actually work as per the budget means you don't now not think. There's no thinking here. You are rigid. Rigid means what? You have to work as per the budget. And you may have another idea of what to do. But basically, because you have a budget, you have to work as per the budget. Number two is what? Inaccurate forecast. So budgets are based on assumption that may not hold true. Lead to what? Poor decision making. So sometimes in a budgeting, we may use the current market rates. But things can happen within 1 month. Basically, there can be an occurrence in the market that may trigger the price to start increasing. Maybe some speculations on issues or on future supply or demand of certain. Basically, we make budgets based on forecasts, but sometimes we may have wrong forecast or may forecast wrongly, and then tomorrow we find out what we either have less money or we had budgeted a lot of money instead of what just a less amount of money. There's somebody who has written something here. I want to look at it. Or government regulations. That is good, Gilbert. And I think that's good. That's another factor that what determines what determines basically level of payment. Union can now advocate for what? Higher pay sometimes. Now, question 3B. 3B asks, identify 6 biases that could compromise the decision-making process. This question we have done it severally, not once. This question on biases, this one we have done it. So we'll just look at it, but this is a question we have done. So there's something we are seeing that questions keep on repeating themselves. So let's look at some of this bias. Number one is called confirmation bias. It is to seek information that supports pre-existing beliefs and ignore correlation beliefs. So basically, this one means what? Talk about confirmation bias means what? You make a decision based on what? Pre-existing belief. My belief. This is what I believe. So, and I need to make a decision on a concerning some issue. Then look at my belief and then make a decision. If I'm a Christian, if I'm an accountant, if I'm a procurement, so this is what? Based on my belief, I make a decision. Number two is called anchoring bias. So relying heavily on the first base of information encounter. So the first information I was able to get is what I use to make decisions. Any subsequent information, I don't use them. I depend on the first information. That's called what? Anchoring bias. So you anchor your decision based on what? On the first information that you got. The next one is called overconfidence bias. The people that are very overconfident, they believe that what? They know they are all know it all. So they can just make decisions without any problem. So that is also another aspect that we have to look at. We talk about overconfidence bias. So believing one's knowledge and prediction are more accurate than they are. So sometimes you can be overconfident for no reason. Sometimes you may find that what? You may think you know and you don't know. That's another bias. Then you have something called recency bias. So sometimes you have a bias that, well, this one worked last year, this one worked last month, let me use it. So giving undue weight to recent events or information. So basically use the recent information or recent event. This is what we did last month and it worked. So I'm going to still use it again this month. So it may backfire because conditions that were there last month and this month may differ. That's called what? That's called recency bias. Means you base your decision based on what? On the recent occurrences. Then you have something called availability heuristic. This is also another bias. This one doesn't have the name bias, but it's also one of the biases you're likely to face. So judging the probability or events based on how easily examples come to mind. So this means what? You can be able to support what you're saying using what? Some examples. Then you have what's called groupthink. Groupthink, we said that this is a case whereby you want to be part of the group decision. So you don't want to what? Come up with a different opinion. So groupthink means what? You don't want to make the people in the group feel like you are contradicting their opinion. So you accept things that majority accepts, even if you have a contrary opinion. So that's called groupthink, whereby you don't want to go against the group decision. So you support them, not because you like them, but because you feel like what? You don't want to be the antagonist in the group. That will say that we want to chelewesha hapa. So basically, that's called what? That's called an aspect of what? An aspect of groupthink. Somebody has written something here. When do you want me to explain what's called the recency bias? Recency bias basically means that you make decisions based on what had worked recently. Like last month, last month we made this decision and what? It worked. So I believe that because it worked last month, it will work this month. That's called recency. It means what? You look at what decision that you made successfully recently, and that's what you make again. That's called recency bias. I don't know if you answered, Wendy. Are you answered? Good. Then, those are the biases that you talk about. That question has been repeating itself several times. So be very careful with that such kind of question that keep on repeating themselves. Next question is describe 5 marketing management philosophies. So basically, we are talking about the marketing philosophy. This is also a question that has repeated itself. We talk about the marketing philosophy. Some people call them what? Marketing concepts. You can call them marketing concepts or marketing philosophy. So let's look at some of the philosophy or concepts that we have in marketing. The first one is called the production concept. So these are basically a philosophy or a concept. These are basically aspects of theories. You can still go and criticize the theory or the concept. So the first one is called the production concept or the co-production philosophy. So assumes customers prefer that products that are widely available, affordable, hence focus on mass production and things. So basically, this philosophy believes that customers will buy what they see. So you work as a company to make the products available. As long as they are available and affordable, customers will buy. That's the philosophy. It's about availability. That's why you see even those in the streets, they're selling hookahs. They make items available. You will not plan to buy a shoe, but then you see a shoe and then what? You buy it. and you see the word is affordable. So first you see it, and then you ask how much you selling, then you end up buying shoes and you didn't even plan for. That's called what? That's called production concept. So you produce in large quantity and then you make them available and customers will buy, because sometimes we are visual beings. We buy what we see. Now, number two is called the product concept. This basically say that what? Customers will buy products with superior quality. That's what. So emphasize product quality and innovation, believing customers value superior features and performance. So basically, this is about quality. So this one say that one. Customers will only buy products which are of good quality and innovative features. So if you're doing production, produce products which are very quality and have got what? Innovative features. Features basically. Then you have number three, which is called the selling concepts. So assume that consumers will buy enough products unless they will not buy enough products unless there is a strong promotional effort. So when you talk about the selling concept, it believes that what? Nobody will buy your product until you convince them. You market the product till you market. So basically, I say that selling means what? That nobody will buy unless you inform them and convince them to buy, they'll buy. Then you have what's called now the marketing concept. This is whereby basically you go to the customer, ask them what they need, and then come and produce. So focus on identifying and meeting customer needs better than competitors to achieve approval. So this is basically where what? You ask the customer about their needs and then produce goods and service that will meet their needs. In that case, you sell more. And then number five is called societal marketing concept. Basically, this one means they say that what? This one advocates for balancing company profits, consumers around, and societal well-being in the marketing strategy. So this one is a tripod, looks at three things. Look at the company profits. So this philosophy that what? As a company, you should be able to look at three things in terms of strategies. Number one, you must look at the company should make profit. Number two, there must be customers should be satisfied. And number three, society should be protected. So don't pollute the environment. In trying to give us the best quality food, ensure that what you don't pollute the environment, because you may be giving us food here and also you are killing us based on what? On those chemicals that are there. The next question here is asking, identify two roles of management as advocated by Henry Misbach. We have talked about Misbach theory. This theory has also been very prominent here. So you asked about you asked to identify two roles of management. Number one is interpersonal role. So basically, Misbach decided to categorize these roles. So number is called interpersonal role. So this involves managing leadership through roles such as what? Figurehead, leader, liaison, for instance, a manager represents the one. So basically, it talks about what? What's called interpersonal role. For example, aspect of what? As a figurehead, as a leader, as a liaison officer. Number two is informational role. So as a manager also, Henry Misbach said that what? You also provide information. So this involves gathering, processing, and disseminating information. Managers act as miners, disseminators, and spokespersons. So basically, those are what? Those are perspective where we look at it. Next question is asking, describe 4 benefits of setting clear objectives during the planning process of what? Company. So this is basically the planning, one of the management function of the planning. So they're asking about what? About benefits of setting clear objective when you're planning. And one is what? Provide direction. Basically, when you have an objective, you work towards achieving it. So whatever you do must be in line with what helps you achieve the objective. Number two is facilitate measurements of performance. So basically, when you have an objective, then you're going to measure your performance based on the objective. If you're doing 4 units now, this is that this one should get distinction. Sorry. This one should get distinction. So basically, that is something you at the planning stage say, but I'm going to do exam, but distinction. Now, after the exam, you find that you will not get the credit. So basically, there's a discrepancy. Now you find out why did I get credit, but I expected what? Distinction. And then another one is enhanced coordination. Just a minute. So next aspect is what? Measure performance. Then number three is enhances coordination. Very true. When you have an objective, then basically objective of the company should be able to unite different sections or different departments. You could be doing different things, but when you have objectives, then basically all of you will work towards achieving the same objective. For example, if your objective is what is to maximize profitability, then whether you're an accountant, a marketer, all of you, whatever you do, must ensure that what that objective is achieved. Then number four is motivates employees. That's very true. Anytime you have an objective, it motivates you because you want to meet it. So you wake up early. If you want to get distinctions in all your units, and basically it motivates you. You wake up early, read so that you ensure that what you achieve it. But if you don't have an objective, then you just guess what you want to get. So as long as I pass, that means what you don't have like an objective, and you may end up failing because you don't have an objective. You may not give it more attention. Next question here is asking, explain five advantages of line and staff organization structure. So you ask about advantage of what? Line and staff organization structure. So number one is specialization at work. So this structure basically is that what everybody does what they're specialists in. So staff specialists provide an expert advice to line managers, improve the quality of decision making and enhance what efficiency. So basically, that's aspect of. Number two is what? Better decision making. So staff experts contribute technical knowledge, analysis into what? A more informed and effective decision. So basically, you ensure that what you have expert and they'll do what make the validation. Number three is what? Relieves line authorities. So by delegating advisory function to staff, line managers can focus on more on operational activities and leadership. So basically, it means what? This kind of structure normally lifts some burden from you, so you're able to concentrate. Number four is what? Improve coordination. So staff officers help in coordination between various departments by providing support service and linking. So basically, this structure also ensures that what this aspect of coordination, irrespective of the department you are. If you're in marketing, production, accounting, procurement, there will be coordination using this structure. Then number five is what? Flexibility and adaptability. So the structure allows for growth and expansion by accommodating specialized staff roles within without altering the what? The core. Right. So basically, I'll talk about what? Aspect of what? Flexibility and adaptability. Next question here asks, outline 5 qualities of a good leader. Now, this is one of the simplest. This paper was very good. I hope they give you a paper like this. Outline 4 qualities of a good leader. Number one is you must be a person of integrity. You must be somebody that people want to meet. You are honest and you're there to the moral principles. Number two is visionary. As a leader, you must be somebody who sees far. You must tell us where you want us to be in the next 5 years. So you must look beyond today. You must look beyond 2020, 2025, 2030, 2040. You must what? Have a very big vision. So I think let's have what? Clear vision and future is first. Number three is what? Decisiveness. As a leader, sometimes you have to decide. And some decisions are going to be painful to other stakeholders. But as a person, you must work. When you decide something, as long as you know that you've been able to do research on it, then basically you go. So leaders must make timeless and accelerations even in uncertain situation. Then communication skill. That's very true. As a leader, you train, you talk to people. So you must have good command of both spoken and written language. So as a leader, you must be able to what? To have better communication skills. Where are we? Are we able to look at this? So I think this is where we are. So communication skills, look at that. Then the next question. So that examine 3 features of a good plan. When you talk about a good plan, what a good plan should have which features? Number 1, should be specific and measurable. Basically, we talk about the SMART. You have talked about the SMART aspect. A good plan, a good objective. We still apply the SMART acronym. SMART is basically an acronym for specific, measurable, achievable, realistic, time-bound, SMART, and time-bound, basically. So a good plan should be specific and measurable. If you're developing a plan, be specific and also ensure that what you're able to track. Then realistic and achievable. Don't be overambitious. Just set a plan that you're able to achieve at your level. Look at the resources you have. Look at the human resource. Then what? Plan. Then flexible. Basically, in the modern day business, there's a lot of factors that can affect operations. So basically, you must ensure that the plan is flexible. Don't have a rigid plan, because if you have a rigid plan and then something happens which is external to the business environment, for example, there's a political issue that has happened that can affect. There's an economic issue. So basically, we talk about the external factors. Those ones are able. So you must make your plan in such a way that what? You are able to what? You are able to at least adjust. That's flexible plan. Eh? The next question is asking, explain 5 conditions necessary for what? Successful brainstorming session. So if we call you, for example, sometimes you want to come up with a new idea. Then you call the staff members in a room, and then or in a boardroom. Then you asked, let's brainstorm. We want to set up a new business or want to start what? A new business line. Now, can we brainstorm on which one is the better? So people come up with the new ideas. Some are objecting, some are supporting until what? We make up. So we look at each idea that's brought about. We look at their merits and demerits for decide. Now, so number one is what? You must have a clear problem definition. What are we brainstorming about? Basically, for us to be called for brainstorming, there must be an issue or a problem to be solved. So you cannot call us to brainstorming session without telling us what are we brainstorming about. That's called the problem or definition. Number two is what? Open and non-judgmental environment. Anytime you call people to get their opinions, don't be judgmental. Some people will come with very awkward to you. They may look very awkward to you, but to them, they are trying to bring in. So anytime you're going for a brainstorming session, every point is considered valid when they're being, unless you discuss and decide otherwise. So you don't judge somebody's opinion or somebody's point. Ensure that you listen to them. And then encouragement of all ideas. In a brainstorming session, there's no idea that is going to be dismissed. It will be dismissed cumulatively. Don't say that I'm the chairman. That's not practical. Let the committee or let the group now decide on whether to go ahead with the idea or not. Then number 4 is what? Limited group size. So if you want to have a good brainstorming session, then ensure that what? You have a good group. A good group means you must have between 6 and 12 people. You cannot have a good or you cannot have a productive brainstorming session when you have 30 people or 30 employees in a room. That's not. So break it down. Let them have what? 6 to 12, and you can divide them. So that's also true. Then also effective decision. That means what? A brainstorming session cannot happen without what? Without us. There must be somebody that's what is guiding the discussion. Because if you don't facilitate, then some people are going to be dominated. There are people that are very talkative. They are very outgoing. They may end up talking. Other people may end up leaving that session without talking. So you must have able to what? Give each and everybody a chance to speak. That's also very, very important that you look at that. The next question number 6 is asking, list 4 types of leave that employees could qualify for a company. This now basically the HR part of what? Of management. So which are some of the leaves? If you have been you want to apply for leave, which are some of the options of leave that can? Number one is called the annual leave, which is in a year. There's normally what the Employment Act talks about, what the number of leave days that you need to have. Then sick leave, this basically leave that is what? Leave that is granted when you're sick, you're not able to come to work, then basically you can apply for sick leave. So granted to employees is unwell and unable to attend work due to what? Illness. Then we have maternity or paternity leave. Basically, if somebody is approaching maybe delivery, they're normally given some time, and then also after delivery, they're given some sort of what, at least their children can be able to what, be stable enough or be at least strong enough to be able to what, survive. So we have maternity and paternity. Maternity for the ladies. So they take it for their own. But when ladies or women take paternity leave, they're normally there. So with us, I think it's such an advantage that it helps us also to start masquerading around, moving around the office. We don't take it to be around, basically. So I don't know who has, and sometimes we don't, even if we take it, we may not even tell our spouses that we have taken paternity leave. We still disappear, come back late. I am. Then you have what's called what? Compassionate leave. Basically, when somebody loses somebody, then it's occurs. So granted on an employee to deal with what? Personal emergencies such as what? Death of an illness or close relative. Basically, if you lose somebody very close to you, the company should give you, be compassionate enough to give you what? Sometimes to go and what? To go and maybe bury them and so on and so forth. So basically, as another thing. Yes, we take it wrong around. No, we don't take it to like be around sometimes. So those are the some types of leave that you can be able to have. The next question is summarize 6 guidelines for effective decision making. So what are the guidelines? So if you want to make a decision, what are some of the guidelines? This question has also been repeating itself again and again. So number one is what? You must define the problem. For you to decide something, there must be a problem you want to face. Maybe you want to start a new business. So those are the issues. So understand the issue and before making the decision. Number 2 is what? Gather relevant information. So someone say that, okay, I have some amount of money, I want to start a business. So the problem is what? You want to set up a business, you have not decided. Then number 2 is what? Now gather information. Look at the various businesses around that options you have, and then gather information. M-Pesa, advantage, disadvantage. Okay. Having a beauty shop, advantage. So basically, let's call gathering information. Then identify alternatives. So as you gather information, identify alternatives. That these are the options I have. Then evaluate each option. Look at the advantage of each of the business you want to start. M-Pesa, advantage yake gani, disadvantage gani? Beauty shop, advantages, and then make a decision. After evaluating then look at the one which is what? Least risky. So go for the business what? That's the least risky as per your evaluation. And then implement the review basically. Now say that now this is I'm going to start an M-Pesa, and then what? Go and set up the business. But we say that there's no business which is already, there's always risk in every business. There's no business which is what? There's no risk-free business, definitely. The next question here is asking, analyze 5 elements of behavioral theory of management. So basically, this is also this is a question on theory of management. So behavioral theory, which are some of the elements? Number one is what? Motivation. So basically, this theory emphasizes that what? For you to ensure that your employees perform better, then ensure that what? You're able to motivate them. And this one, an example of this theory is Maslow hierarchy of needs can lead to what? Higher. So if you motivate employees, then basically they become more productive. Now, this leadership style, so focus on impact of different leadership styles, e.g. democratic, autocratic, on employee morale. So basically, this behavioral theory also talks about what aspect of leadership style. They say that what the type of leadership that you apply in a given business either motivates or it motivates employees. Then number 3 is communication, basically behavior aspect of communication. So you want the importance of open and two-way communication between management and staff for effective collaboration. So it's important that one show that what. So this is another aspect element of this theory that what there must be a good communication. There must be what's called a two-way communication, whether suggestions, whether the commands, but there must be. Then group dynamics highlights how informal groups and team interaction influence behavior, cooperation, and product. So basically, this theory also talks about what group dynamics. You must know in a group how do they be grouped. There's something called group formation process or group formation. Talk about the formation, forming, storming, norming, and performing. So basically, you must know how to handle a group with this theory. Then employee participation. So this theory also advocates for that employees feel motivated or feel part of the company when they feel like what anytime the company wants to make a decision, major decision, they are involved, they are participating, they give their opinions, their views on that. That is that question. Question number 7 is asking, list 3 prerequisites for effective delegation of authority. Means what? Pre means before. Before you delegate authority, what are some of the aspects you have to look into? Number 1 is clear definition of duties. If I want to delegate duties for 20, the first thing is, what am I delegating? And what am I expecting her to do? That's number 2. Then number 3 is what? Competence of subordinates. Now, before I delegate, all of you are my juniors. Hypothetically, I'm just giving an example. Now, there's some work I'm going to give Ambuche because Ambuche could be competent in that area. There's some work that I can give Jed, but not Orangi. But there's work I can give Orangi and not. It means what? As a senior or as a manager, you must know the strength of your junior so that if there's an issue of communication, who is confident and eloquent enough to be able to pass information, that one said, okay, let's give to person X. If it's something that requires research, who is good in being keen and doing research, say that, oh, B can do it. So basically, you must know, before you delegate, if it's an accounting issue, I must look for somebody good in accounting. Then trust and confidence. Also, you must delegate duties to a subordinate that you trust and you have confidence in. You don't give somebody you don't trust, because if you don't trust them, they can mess you up in that work. Next question here, number B, says that highlight 5 skills of effective manager. This one you know. You must you have good leadership skill, you must have good communication skill, problem solving, and even time management. So basically, those ones are things we have looked at and they are self-explanatory. So we can be able to look at that. The next question here is asking, summarize 5 key concepts of Mary Parker Fallett's theory of management. This one has also come. This is, I think, the 4th time you're meeting it. So this is an area of interest. So what are some of the concepts? Talks about power with not power over. So that if you are so that advocate for collaboration, power sharing instead of what? Authority. So if you're a manager, you must try to collaborate, share your power as opposed to what? Trying to amass all the power to dominate. Number 3 is what? Integration. Emphasize resolving conflict through integration rather than what? Compromise or victory of one party. So they say that in case there's any conflict, we must solve it in such a way that what? Everybody feels better about it. Not some people feel that they have lost, some have win. So basically, say that what? If you're solving a problem in the company, show that what? It brings what's called a win-win situation. Everybody feels like what? At least the decision has not hurt them in a way. Then group influence, so belief in power or group dynamics and participation. So that what this also Fales talks about what group influence. Decide as a group, not individual. So that's that this is what you do as a department, as a team, or association. That what you decide based on a group, not on individual. Then coordination of as the essence of management. So that what as a manager, you have different sections or departments to manage. So that means what? You must ensure that what? There is what's called good coordination among different departments doing different things to ensure that the company achieve its objectives. And the last one there is what? Leadership through participation. Be somebody who allows others also to participate. If it's about deciding something, let people also be part of the decision. Don't be some all know it all, whereby you dominate everything. The last thing is outline 8 steps in implementing change in the company. This one also we are talking about it. Number one, recognize the need to change. For us to change, there must be a need to change. So we must recognize that what people are going online. Also, we must go online. People are going digital in this business area. Can we go? So this then what? Define the change clearly. Now tell people that this is the change. This is what we're going to do so that people understand. Because we talked about resistance to change. People resist because what they don't. So number one is what? Define the change clearly, and then develop a change strategy. You must also have a change to implement it. Maybe it can be in what? It can be gradual change. You must have a sister strategy. Then what? Secure leadership support. So basically, leaders must support because some change requires what? Requires resources, both financial, human. And this one, the people are custodians for this are basically management. So if management don't buy the change, they cannot happen. So ensure that for you. Then communicates the change. That means what? Now let all the shareholders or stakeholders know about the change and convince them to support it, and then involve employees. Now these are all stakeholders. Ensure that employees understand the change. Tell them what's expected of them. Their roles, how they want to change. Train them if you want to train them, and then then implement the change. Put it in place. Then roll the change using defined strategy and monitor progress. And then last one, evaluate and reinforce. Evaluate means what? Look, check if the change is helping the company better. You see, if you bring a change and maybe it costs us some money, then you must be able to see the impact. If there's no impact, then basically we spend money for no reason. So we must evaluate to see if the change is really helping the company. That is all. So for today, I want to stop there. I believe that one remaining paper, you can go through it. The answers are there. So I want to stop there today. And also, I want to wish you success in the upcoming paper. We pray for you. We are praying for you. And we are really rallying behind you that you get good, questions. At the same time, you have all it takes to pass this exam. The reasons to pass exams are more. You have been able to be taken through this course by very competent lecturers. You've revised well, and I believe that there's nothing that can make you panic. You just go for that exam, be confident, revise, go for the exam, do exams, and then what? Come back to class, continue with the learning, because definitely we are sure that you're going to pass. That's number one. Number two, this class has been very good in terms of interaction. I've enjoyed teaching this class more. That's why you see that we try to come early, because every time I come to class, when I log in, I don't even take 2 minutes, somebody is ready. Yeah, so this has been a very good class in terms of interaction, answering question. I even gave you a card and you did it even virtually. So basically that's what that commitment. Sometimes God bless us because of the effort we put in. Some people have passed exam and even wonder, this guy, how did he pass? Because of what? The effort. When you put effort, even God himself feel like you need to pass. So basically, we are rooting for you to pass. So continue having that spirit in subsequent classes. Continue upgrading yourself. Invite your friends to be coming to class. Tell them we have a very good college here. Recommend them, let them come so that we'll be able to grow together. When you get a paper, basically, you add value to yourself, to the company, and also make you very relevant. So I think that is what I can say. And also, I'll also give you a right of reply so that somebody here would also want to say something. So I'm going to, for today, I'm going to, let me see if I can be able to, So I'm going to allow somebody who is up with an opinion to be able to say something. So I've allowed you to unmute yourself. You may want to speak, so you can mute yourself and maybe say something. So that somebody you can be able to talk about. Somebody can, any person who can be able to talk on behalf of the class concerning the semester and what you think about it, then basically we can just call it a day. Anybody who is confident enough to say something about the class, how the class has been, assessment of this class? Anybody?
Yes, sure. Am I audible?
Yeah, I'm getting you, Gilbert. Getting you well.
Yes, I'd like to take this opportunity and on behalf of my colleagues, just to thank you, Mwalimu, for taking us through the session. Through the unit, it has been a great unit. You've made it as simple as a baby can comprehend. So we believe that we are ready for the exam. I don't see any challenge in terms of handling any question with regards to this unit. Since you've made everything clear, you've taken your time to just explain the areas that we've had issues, and I really thank you for that. Thank you for always being in class. You've never missed any class. You've always been there. You've always been flexible in terms of even giving us breaks in between the classes. It has just been a great experience. And I believe that if focus continues that way, it's going to go far. Even if it's possible, by the way, if you can share, maybe if you can talk to focus and have evaluation. If possible, maybe we can evaluate our lecturers after our classes. It could be a good thing in terms of also motivating you, and number two, also to help improve even in future. So mine, I'll leave it at that. I really appreciate Mwalimu for everything, even for the cut. It was an eye opener. Thank you for preparing us. Thank you for making impact to us learners, and I believe that you're going to continue the same. And thank you. I think I'll leave it there. Over to you.
Thank you very much, Ambute. That's a very good analysis of our class. I think he's been able to crown it all and talk about the class. So it's always good to get opinions from you, and from your compliments or from your opinions, the class has been okay. Although there could be one or two things that might not, maybe examples that might not have, or whatever I might have said that maybe, sometimes in a class, in giving examples, you may, it's like in church, sometimes preaching, somebody can touch. But basically, that was, there's no, in case there's something that came out in terms of explanation or giving example, that might have not been in good side of you, I apologize. Those are some of the risks that we normally have in teaching. So we wish you well, and we'll have testimonies here next time that all of you who attended this class and any other unit that is being taught at 𝐻𝐿𝐒 College have passed well. So for today, let's say bye, and then we'll meet again next time in case given a chance. So with those three remarks, I wish you well in the exams. We are going to pray for you, and we'll have testimonies of good. Thank you very much. Have a blessed week and success in your exams. Thank you, and may God bless you. and those are followed to the letter, or they are through the letter. That is basically called what? Call it what? So that where the relation, repetition, and quality control are critical, bureaucracy ensures uniformity and efficiency. Because when you're producing goods, basically, if you're producing loaves of bread, there's aspect of uniformity. If it's about 600 grams, you produce 600. So you cannot find something, some are 30, 50. You normally ensure that what? In terms of quality, in terms of quantity, then the quantity remains the same. Even if you produce what? 1,000 or 1,000,000 units, that is very, very important. It's a very important aspect you have to look at. And there is what? Healthcare institutions. Basically, matters health, there's no shortcut. In matters health, regulations have to be followed to the letter. Because if you take a shortcut in matter health, somebody can die. You can use, you may do something that we may even what end up losing somebody or end up losing life. So basically, it's important. So also, health regulation rules rely on strict protocols and hierarchical structures for safety and legal compliance. Now, talk about strict protocols. There are protocols we followed. When somebody faints, there's a protocol. When somebody has had an accident, has broken limbs, there's a protocol. You cannot come with your own way of doing things. There's a way in which what? When an ambulance comes to the site of an accident, there's a protocol. You don't just come and carry people. There's a way to do their things. So basically, that's a procedure. So that if you go against the procedure, you can even be sued. You can even sue God, of course. So basically, it's important that what we look at those aspects of in health, because what? The nature of the institution. When we talk about healthcare, healthcare is very what? Is very, very critical in, and also it's an area that if you make a mistake, then basically you may end up what? Causing a lot of damage, and even what? Loss of life may occur. Then number 4 is what? Military and police forces. This is where order is normally being used. In military or in police, you don't question. If you're told to march, you march. If you're told to move forward, you move forward. If you're told to shoot, you shoot. Basically, that's called what? Order. So in those cases, you don't have time to reason. You don't have time to reason until this is what, no. What happens is that in this case, you need to ensure that what? You follow the order. If you want to resign as a military officer, there's normally what? A rule to follow in ordering. So basically, that is very, very important. Very, very important to look at. Then next one is regulated industries, e.g. banking and aviation. Now, when we talk about banking, in the banking sector, I don't know if you're going to the bank, and sometimes you even feel bad. You're told to do a signature, and then your signature varies slightly with what you had signed when you're opening an account. Then start feeling bad. Say that's why you denying me my money, and I'm the one, you can confirm my face. Because there's what's called protocol. We can know you, this is you, but basically you have to give a good signature. You have to sign the way you normally sign. That is called protocol. When we talk about aviation, flying of planes, landing of planes, there's a protocol for starting a plane and flying a plane. There's a protocol for landing. You cannot land the way you want. You have to follow certain procedures. If you miss those procedures, basically you can bring a you can end up causing a very, very, very big accident. So it's important that we look at those aspects very, very, very carefully. So I don't know if that question is asked well. I don't know if the questions are answered, or is a question you need me to elaborate again? Any question? Any question? I think there's somebody who asked me to look at that question, and I think I've been able to repeat it. So if you have a question, Okay, I'm guessing, let me get a clarity from what I think this is Ambuche. Ambuche is asking, the question asks when. It's confusing because what? They asked, discuss situations. Now, let me read that question so that we get to understand that point very clearly. That up. Highlights 5 situations. Situations when you apply the theory. Maybe the way the structure is the way the questions are, the answer are put could be. Now, if you look at the introduction part, how I've introduced it. Look at what the answer is. Look at how I've introduced the answer. That Weber's rule theory is best suited for structured, rule-based environment. Is applicable in the following situations. The first situation was in the public sector. If you're in the public sector, whether county government or national government, basically you apply, or person you apply the rules. In large scale manufacturing, you see, the answers look a little bit, I don't know, there's an aspect of non-clarity, but if you look at how I've been able to introduce them, I've talked about the situations that can happen. So I understand where Ambuche is coming from. Ambuche, maybe you expected us to say, for example, the first situation could be areas where we need what? Strict adherence to law. That was what you ought to have, you are expecting that we say that number one, a place where there's what? There's strict adherence to law. Number two could be a situation where what? There is standardization, repetition, and quality control. Number two. Number three, we talk about what? An area which is what? Controlled by a lot of regulation, as a field or an industry which is what? Controlled by certain authority. And then also what? Talk about what? Areas with the what? The strict regulatory framework. So basically, understand how you come. But basically, you can, in both cases, you can still be able to what? To answer that question, get the question right. I don't know if Ambuche now you understand. So understand what you're saying, eh? We have talked about, we are talking about, in this case, I've been able to talk about institutions, eh? But the question was asking when. So basically, maybe how I'm explaining the institution, that when comes in. But I understand your point. Your point is so very correct, because you talk about what? You talk about them, and then you give an example. For example, you talk about number one, you talk about, for example, industry where the strict adherence, then you explain, then what? Example, public sector institutions. So basically, that would be also a better way of answering. That's also another way of answering. So I don't know if now it's clear, Ambuche. Is it now clear? So I understand now the situation. I think I've been able to illustrate the confusion. Now we're good. Now I'm asking because people are quiet. I can't really remember where we were. So I was asking, where were we last time? People are quiet. I don't know if we didn't indicate where we were, or we didn't indicate. So which paper were we doing last time? I may not be able to remember, so I'm requesting that in case anybody with an idea where we were last time? Anyone with an idea where we were last time? Anyone with an idea? You want to proceed? Or I just select a paper? Okay, since we are not sure, nobody is sure, I'll select a paper, then we can be able to look at it. So, I can see somebody is saying something. So, Somebody has written something. Okay, so random paper, but I don't want a paper that we have discussed before. So random paper means I have to come down here. The ones that I'm sure we are not being able to cover must be papers which are now down here. So let me select a random paper down here with this one here. April 2024. This one you're done. Group decision making, this one you're done. This one you're done. So can you see that one you're done? This one. Marketing research, this one you're done. Company text marketing research, that one you're done. Let me look at another question here. Business incubation, access body, this one you're done. Incubation, you're done. This one now. I think this one now. Yes, this one I think we are not done. So let's look at this question, number 6, so that we don't take much time. We can proceed as a group. Now, this question is asking, the question asks, outline 5 types of decisions made in a company. So if you have an organization, which are some of the types of decisions that are likely made in a company? So I want to look at some of the types of decisions that are likely to be made. Number 1 is called strategic decisions. So these are long-term decisions made by top management. They define the direction of the organization, such as what? Entering new markets or launching a new product. So when we talk about strategic decisions, these are normally made by the strategic level management, which is basically the top level management, and their work is to ensure that what? These are basically, for example, we talk about issues like entering a new market. That is the decision that has been made by top management. They sit down and say that now we want to expand. So we want to expand to which markets? We want to expand to Ugandan market. So basically, that is one of the decisions. Then number 2 is what? It's called tactical decisions. The second one is called tactical decisions. Which are these decisions? Now these are made by middle level management. You see, strategic decisions are normally made by top level management. Now, these tactical decisions are made by middle level managers, means in between. These decisions focus on how to implement strategic plans effectively. For example, developing marketing campaigns or recruitment plans. So basically, those are called tactical. They are normally mid-level management decisions. So once the top level has made strategic decisions, now implementing them is normally what? Done at that level. Then number 5, we have what's called operational decisions. Operational basically means what? These are day-to-day decisions. These are normally decisions that happens on day-to-day. Operations, you come. Those are, we call them what? Daily decisions, or decisions that are made on daily basis. So that these are day-to-day decisions made by lower level managers, so managers or supervisors, to ensure routine tasks are completed efficiently, such as scheduling staff or managing inventory. So basically, operational decisions are made by what? The junior level or the lower level managers, and they are normally what's called day-to-day operations. We will give an example there. Now, the first thing we talk about, strategic number decisions are normally made by top level management, tactical or mid-level management, and then what? And then operational, basically the lower level management. Then the next one is called program decisions. They say the way the name suggests what's called program, means they're repetitive. When we talk about this is how this system is programmed, means it can do a repetitive task day tomorrow without any problem. So these are repetitive and routine decisions made by following established guidelines or rules. For example, reordering stock